Worried about your job or the rising cost of living? You're not alone. Recent statements from Federal Reserve Chair Jerome Powell paint a picture of an economy at a crossroads, and what he's saying could directly impact your wallet. Let's break it down. According to tweets and reports from October 29, 2025, Powell indicated that the overall outlook for employment and inflation hadn't shifted dramatically since the Fed's September meeting. This might sound reassuring on the surface, but digging deeper reveals some potential storm clouds brewing. Several news outlets, including Bloomberg and Zero Hedge, highlighted key takeaways from Powell's statements. Key points from Powell's statements. Labor market cooling. Powell acknowledged that the labor market is showing signs of gradual cooling. This means job growth is slowing down, and while unemployment remains relatively low, it has ticked slightly upward. This trend could signal a potential weakening of the economy. Think of it like a car slowly applying the brakes. You're still moving, but not as fast as before. Inflation's still elevated. Despite efforts to curb rising prices, Powell stated that inflation remains somewhat elevated. This directly impacts consumers, as it means everyday goods and services are still more expensive than they used to be. And this is the part most people miss. Somewhat elevated is subjective. What one person considers manageable, another might find crippling. Growth on firmer trajectory. Before shutdown, Powell noted that prior to a government shutdown, data suggested the economy might be on a more solid growth path. This is crucial because it implies the shutdown negatively impacted economic activity. The shutdown temporarily weighed on economic activity. How much? That's the big question. Rising downside risks to employment. Perhaps the most concerning point is Powell's acknowledgement that downside risks to employment have increased. This means the likelihood of further job losses is growing. This is the part that could spark differing opinions. Some might argue that this is a natural correction after a period of rapid growth, while others might see it as a sign of a looming recession. Layoffs and hiring remain low, but declining. While layoffs and hiring remain at relatively low levels, the availability of jobs and the ease of hiring are decreasing. This suggests that businesses are becoming more cautious about expanding their workforce. It's like a game of musical chairs. Fewer chairs are being added, making it harder for everyone to find a seat. The Fed's stance and future decisions. The Federal Reserve, acting as the central bank of the United States, aims to promote a healthy economy through monetary policy. Their primary goals are maximum employment and stable prices, inflation at 2%. To achieve these goals, the Fed uses tools like adjusting the federal funds rate, the interest rate at which banks lend to each other overnight, and managing its balance sheet, the assets it holds. Back on October 29, 2025, the FOMC, Federal Open Market Committee, decided to lower the target range for the federal funds rate by 0.25% to 3.75% to 4%. They also decided to conclude the reduction of its aggregate securities holdings on December 1st. These actions were taken to support economic growth and combat downside risks to employment. But here's where it gets controversial. Two members dissented on this decision. Stephen I, Miron wanted a bigger rate cut, 0.5%, while Jeffrey R. Schmid preferred no change at all. This highlights the internal debate and uncertainty within the Fed itself. Powell emphasized that future decisions will depend on incoming data, the evolving economic outlook, and the balance of risks. He specifically mentioned monitoring labor market conditions, inflation pressures, inflation expectations, and financial and international developments. Inflation concerns and future cuts. Powell also addressed concerns about inflation, noting that near-term inflation expectations have increased, partly due to higher tariffs on some goods. He suggested that this tariff-related inflation is likely to be short-lived, but acknowledged the risk of more persistent inflation. He emphasized that the Fed must take a balanced approach, as there is no risk-free path for policy. Importantly, Powell stated that another rate cut in December was far from assured. There were strongly differing views within the committee about how to proceed. He also mentioned that the Fed would enter the next phase of its balance sheet management in December, holding steady for a period. Tension and uncertainty. Powell explicitly stated that there is tension between the Fed's two goals, employment and inflation, and that strong views exist across the committee. He described the October rate cut as a risk management move, suggesting that future decisions will be more challenging. He also noted tightening in money markets and assessed reserves as only slightly above ample, seeing little benefit in further balance sheet reduction. In conclusion, Powell's statements paint a complex picture of the U.S. economy. While some indicators suggest continued growth, there are also significant downside risks to employment and persistent inflation concerns. The Fed is navigating a challenging environment with internal disagreements about the best course of action. What does this mean for you? It means uncertainty remains, and the future direction of the economy is far from clear. So what do you think? Is the Fed doing enough to combat inflation? Are you concerned about potential job losses? Share your thoughts in the comments below.